Hello, everyone. It is February 1st, a Wednesday. Happy Fed Day. Today on the Final Bar, we'll be talking with Sam Stovall of CFRA Research. We'll talk about the presidential cycle. We'll talk about what happened today with the Fed and where we're seeing strength versus weakness. Ladies and gentlemen, this is the Final Bar. Hello, everyone, and welcome to this Fed Day edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets, particularly a day like today, where we have a lot of news flow to digest. We had the Fed meeting yesterday and today, the press conference this afternoon after the 25 basis point rate hike, first rate hike of multiple rate hikes to be expected here in 2023. The market's overall pushing to the upside pretty nicely here in the afternoon, right? Pretty much right after the press conference start, the S&P, the NASDAQ go from the lows of the session to revert right back to the upside. The S&P 500 closing above 4,100, which might be a key takeaway from today is that renewed optimism, or continued optimism, I should say, going into and now coming out of the Fed meeting. There's always a lot of noise and a lot of big movements on Fed Day. Afterward is where we kind of digest things. Of course, we have a couple other pretty significant things to process, including Meta's earnings today after the close, 3 other FANG stocks reporting tomorrow after the close. So a lot of charts and signals and patterns to review. And let's get right to our market recap. As I alluded to, and as I'm sure you've probably seen by now, the Fed rating upping the Fed funds rate 25 basis points, sort of as expected, right? There was thought earlier about a couple other paths that the Fed could have taken, but Powell's press conference sort of confirmed that fact that this was the first, not the last rate hike to probably be expected, encouraging that inflationary data is starting to look less inflationary, but still not done, right? Not out of the woods yet. With that in mind, though, and with the prospect of higher rates sort of coming down the pike, the S&P, the NASDAQ pushing higher into the close, came off a bit going into the end of the day, but the S&P up to 4120. That's up 1%. The NASDAQ composite doubled that, up about 2% today, still below 12,000. Mid caps and small caps both up as well, not as much as the NASDAQ. And the VIX back pushing lower again. We sort of talked about that 20 level as to whether or not the VIX would hold 20 from above. It's continued to drift lower. And on a day like today of the market moving higher, volatility as measured by the VIX coming off. So fear is dissipating. Optimism is renewed. Things appear pretty strong here overall, to be honest with you. And again, the goal with technical analysis is to think less about why things are necessarily happening, to think about what is happening as evidenced by the price. Now, we're really excited today to have someone like Sam Stovall on the show who knows a lot about a lot. And it'll be interesting to get his take on how you make sense of this sort of relationship between the fundamental, the macro, the technical, all sort of combined. So I thought it was a perfect guest to bring through and help us make sense of things here. Interest rates overall moving lower, had been lower earlier in the day, but really accelerating to the downside after the press conference this afternoon. 10-year yields down below 340, long bond yields around 355. The dollar index pushing lower. That continues the trend of a weaker dollar that we've seen for quite some time now. That's opened the door for non-U.S. markets to be in a position of strength relative to the U.S., which is a huge change from what we saw really up until the October low last year. With U.S. outperforming non-U.S. through then. Gold and silver prices rallying here in the afternoon after 2:30 p.m. Eastern. The rest of the commodity space, for the most part, moving lower. Energy, by far the worst performer out of the 11 S&P sectors. We'll get to the sector movements here in a moment, but certainly sort of the materials side, the precious metals part of the commodity space doing just fine. Cryptocurrencies all moving to the upside along with other risk assets. Ether up above 1630, Bitcoin above 23,500. Both of those in the positive, of course, and most of the top 10 coins that we track in the green today. And that move pretty much all came in the afternoon here toward as equities were rallying around and after the Fed's meeting and press conference. We'll look at a chart of the S&P 500 quickly, and then we'll come back to talk about some of the sector themes and some of the individual stocks, because we have quite a few names reporting earnings this week, and it's so funny. There's so much. Our cup runneth over with charts we could show because there's a lot happening between the Fed and earnings and elsewhere. We've talked for quite some time on the show about the strength of the rally off of the October lows, not just the strength in that prices have gone higher using the major indexes, but the fact that breadth conditions have improved so dramatically, right? And we've talked about the bullish percent index, strong but not excessive, advanced decline lines making new swing highs, small caps leading the way higher, which is more common, honestly, in bull market phases, sort of a risk on feel to things. We've seen the S&P break above moving average resistance, break above a trend line, taking the 2022 highs. All of those things sort of play into this narrative of a market in recovery mode, a market in a position of strength as buyers are overwhelming these opportunities for profit taking and sellers to come in. Most recently, we talked about after we broke above those levels of resistance, which we did earlier last month in January. Question was, can we get above this last level, 4,100, right? That's the highs from November and December. That's the most recent swing high. Breadth conditions like the advanced decline lines have already broken above those levels, but the S&P, the NASDAQ had not. Today, the S&P closing above 4,100 for the first time since August of last year, early September, that is. And so this really, I would argue, completes the rotation, right? We have lower lows to higher lows, lower highs now to higher highs. If you're waiting for some other bullish evidence, I'm not sure what else you would look for from a technical perspective, right? The chart is telling you that conditions are strong. The momentum is improving, right? So the RSI, instead of stalling out at 60, which it did back here in November, is actually pushing above 60, which again is more characteristic of a bull market phase. I would imagine that this break above 4,100 really clears the way to 4,300. We'll see what happens, of course, through earnings. Just like we had a big catalyst to the upside today, we have plenty of other catalysts to try to make sense of and try to understand, how they might influence the markets. Growth has been quite a story relative to value in a way that's very, very different here in the last couple of months. And 2023 has continued that sort of strength and growth, right? Growth over value in some ways. And consumer discretionary, technologies, these are some of the areas of the market that we've seen strength. We have 4 of what I call the phenomena stocks all reporting today and tomorrow. Amazon, Apple, Alphabet, all after the close tomorrow. Meta's after the close today here, so still early on. We'll see how the news comes in and what sort of language we get, and certainly the earnings call will be after we're done with the show. Leading into today, what's so perfect is Meta literally closed almost exactly at its 200-day moving average. Talk about reaching a big question mark level where you naturally want to wait and see if there's enough momentum to push through this level of resistance. Meta recently became overbought for the first time since back here, mid-2021. This is a stock that's been leading the way down and been underperforming so consistently. Now, the S&P bottomed out in October. Meta actually bottomed out a little bit later, gapped lower and had a lower a new 52-week low in November of last year. From there, though, turned very quickly and has made a pattern of higher lows. 50-day moving average sloping higher. We're now testing the 200-day moving average. Again, today's close right at the 200-day. Now, looking after the market, we're seeing a big jump higher. Look at where Meta is at. And again, this is still early on in the after-hour session, but looks like decent earnings coming through. And so far, Meta up about 12% in the aftermarket, up 19 points to 172. If we would open around there tomorrow, that means we're opening up here, which is taking, clearing the 200-day easily and getting up to this congestion area around June, July, August. Now, you have to remember, after our session, a lot less liquid, a lot less participants. It's going to be very fluid, of course, as the earnings calls and details will come through. And after the initial reaction, there's always that sort of digestion. Think of it as we've eaten the big meal, and now we need to sort of sit back and loosen the belt and digest what we just learned. But look to see how this stock opens tomorrow. But the first of the 4 FANG stocks reporting this week looks to be like a pretty decent move to the upside. You get a couple more of those tomorrow, and boy, think about the upside potential for something like the NASDAQ, led and dominated by these mega cap names. It's interesting to note that while the S&P, the NASDAQ finishing so strongly, you have the S&P actually flat for the day. Or excuse me, the Dow, flat for the day. Now, the Dow is looking at a different group of stocks, of course. So the biggest gainers in the Dow today, Intel, Salesforce.com, Microsoft, sort of the tech component. But you have to remember the Dow 30 also includes some names that are outside of the growth space. So you have Chevron, which is down 1.6%. Amgen, which has been a tough chart, down another 2.5% today. Travelers down 3.2%. So sort of the financial, energy, healthcare component there at the top. And even some of the industrial names like Caterpillar, coming down a little bit. It's so interesting when you think about how the market is reacting, when you look at the S&P or the NASDAQ and think about the reaction to the Fed meeting. You have to remember that the markets, the equity markets, are composed by a lot of different stocks with a lot of different businesses. Something like Caterpillar actually gapping down, or seeing some other movements in healthcare, even some financials looking less strong than previously said. Let's take a quick commercial break. We'll be back with Sam Stovall from CFRA Research. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. Good to be back with you live here at 4 p.m. Eastern. We made a bunch of improvements to the studio in the last couple days. We're going to get those all tested up and ready to go. Hope to be live in the studio very, very soon. We'll get it ready when we can. A couple quick announcements before we bring on today's guest, Sam Stovall. First off, we welcome your questions. If you email us your questions, thefinalbar@stockcharts.com is the best way to get your questions in front of us. You can also tag us on Twitter @FinalBarSCTV, or just put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to answer one of your questions live on the air on Friday's show. Also go to StockChartsTV.com. That's our on-demand platform. We have so much great content. We have people like Sam Stovall and many other really knowledgeable market participants and experts sharing their ideas and their perspective. Also, a lot of great special events like The Pitch, our market outlook specials from last month. All of that is available for free at StockChartsTV.com. Or on your mobile device, just search for StockCharts TV on demand. Our upcoming schedule includes tomorrow, Thursday, February 2nd, Dave Landry of DaveLandry.com. This Friday and Monday, I will be off. We're visiting family for a belated Christmas celebration with the Kellers in Cleveland. And my friend Julius de Kempener has agreed to guest host the show from Amsterdam. So he will be driving the Final Bar on Friday and Monday. We've already talked about some of the questions we received recently in the mailbag. He'll be answering your questions on Friday. Also, I think on Monday, he might do a special segment on sector rotation, which is a can't miss discussion. So make sure you tune in on Friday and Monday. The next Tuesday, the 7th, we have Ari Wald of Oppenheimer. Let's bring on today's guest, Sam Stovall. Sam's the Chief Investment Strategist at CFRA Research. Sam, Happy New Year. Welcome back to the show.
Hey, Dave. Good to talk to you again.
Good to see you, my friend. And we have a lot to talk about, to be honest with you. We could go so many places. Fed Day today. We have a bunch of earnings. We have cyclical, seasonal data. We just finished the month of January. So I know we have a number of charts that we want to get to for everyone. You shared some of the bullet points that you're talking about with your clients. Where are you at as you try to process all of these different catalysts we've heard recently?
Well, I'm a bit optimistic, I would say. My target price, 12-month target price, is 45.75 for the S&P 500. And I guess as we exited 2022, people were wondering, how could I be so optimistic? And so I first off tell people that, look, a target price is more of a weather vane than it is a laser beam. It really is meant to offer guidance to our equity analysts, because if their target prices for the stocks that they follow is above the forecast for the market as a whole, well, then they can justify making it a buy. If it's less, then obviously making it a sell. And how I come up with that really is a combination of fundamentals, technicals, and historical precedent. I like to say that fundamentals tell you what, and technicals tell you when and how far. And I'm a big believer in history. I graduated from Muhlenberg College with a history degree, but I also realize that while history is a great guide, it's never gospel. And sometimes, like the singer of the national anthem, it forgets the words. So you definitely have to add different elements to it. And as this list shows, from a fundamental perspective, the analysts know the stocks better than I. So I simply take a cap-weighted target price differential that they have on each one of the stocks in the 500 to come up with what they believe in the aggregate to be the growth potential for the S&P 500. Don't tell anybody, but then I go onto StockCharts.com and I look at the point and figure target price for the largest stocks within the 500 to get a technical consideration as to where the market is likely to go. And then from a historical precedent, I say, look, we were up 7.1% last quarter, which is historically the second best quarter of the year. We're in the best quarter of the year, not only in an average price change, but also a frequency of advance. And next quarter is the third best. So we're in a very strong period for the year. Following down years, we tend to go from first to worst, meaning instead of consumer staples, healthcare, utilities being the leaders in a down year, you tend to gravitate toward those groups that were beaten up the most, such as communication services, consumer discretionary, tech, and real estate. And knowing that you had my friend Jeff Hirsch on a couple of weeks ago, I too like all of the indicators that his father Yale put together. And I guess like Salieri trying to improve on a Mozart concerto or vice versa, I try to add my own spin to many of the things that I learned from the Stock Trader's Almanac.
I'd love to get to, it's a great segue to the first chart that you brought, Sam, because when we talked with Jeff, we talked about the January Barometer, we talked about what that might mean. And thinking about the presidential cycle, which tends to be pretty strong, but January has actually been a pretty compelling indication. Can you talk us through what you're seeing here, given the fact that January ended in a position of strength?
Sure. Well, these bar charts show average price changes. So the one on the left, the gray bar, says that the S&P 500 for all years going back to World War II was up an average of 8.9%. And its batting average, the frequency of advance, was 71%. Okay, well, everyone loves to talk about forecasting recency. Oh, 2022 was a bad year. It's got to be a bad year in 2023. Well, not really. If the market's up 71% of the time, about 30% of the time, it's down. So therefore, the odds favor an up year, especially after a down year. So on average, following any down year, the market was up 14.2% and rose in price 81% of the time. Since I put this chart together before the January Barometer had run its course, I said, well, what about down years followed by an up Santa Claus rally and a first 5 trading days that I learned from the Stock Trader's Almanac? In that case, you ended up with an average 21.6% advance in that calendar year and batting average of 92%. Now that we got a confirmation from the January Barometer, now you're looking at a situation where the market could be up 29% on average. And in each one of those limited, I would say, observations, there were only 8 of them. So sometimes when you add too many if statements, then the observation occurrence gets smaller and smaller, but it is still certainly encouraging as to what might happen this year.
It's such an interesting chart. And I really appreciate you putting these together. When you were mentioning earlier about your toolkit, thinking fundamentally and technically, this may be one of those times, and I'd love to get your take on it. Is this one of those times where we're getting a bit of a disagreement, right? If I think of fundamentals as what we're hearing from earnings, you're hearing an earnings season that's less than encouraging. You have a lot of the FANG stocks that are reporting have been shedding jobs and not expanding. How do you reconcile that with the fact that the markets have been so strong, and certainly the seasonality and the presidential cycle, all the things you mentioned suggest further upside? How do you reconcile that maybe disagreement between the fundamental and the technical here?
Again, prices lead fundamentals. Historically, there is a 75% frequency that if you have a down year, then the next year you see a down set of earnings, or at least a reduced growth rate in earnings. And in that year, when you do have the reduced growth rate in earnings, you have higher share prices. And one reason is because while the S&P is expected to post about a 1% earnings increase this year, down well from a higher forecast earlier on, expectations are for a near 12% rise in earnings in 2024. So the market was down last year in anticipation of weak earnings this year, but the market will likely be up this year in anticipation of better earnings in 2024.
I love that discussion, the relationship between price and some of the other data that might support it down the road. Can we circle the Fed and what we learned today, maybe into this discussion overall? Obviously, the markets have been incredibly strong in risk assets. We have Powell today talking about, future rate hikes as certainly being in the cards and 25 basis points now, but further down the road. Did you hear anything today, or what is your perspective on how the Fed raising rates aligns with some of these patterns and projections that we're talking about so far?
Well, it sort of reminds me of 1994, early 95. We had 7 rate hikes over that 11-month period. This time we've had 8 rate hikes over an 11-month period. And essentially, when investors get the sense that we are much closer to the end than just the middle, then the market tends to look across the valley. The market knows that historically the Fed starts to cut interest rates an average of 9 months after the last rate hike. And with the economy beginning to slow, obviously the employment data has offered support, but the Fed knows that it is aiming at a target that's on the other side of the horizon, so it doesn't want to overshoot that target. And I don't think that they want to go too far to throw us into a very sharp recession. So right now, the market is already factored in a soft landing or a mild recession, but I think that they're now beginning to look across the valley to a better fundamental and monetary setup in the latter part of this year.
Yeah, and you're certainly seeing a lot of that optimism. One of the other charts I wanted to bring up that you brought with you, Sam, was this one looking at what I sort of think of it as offense versus defense, right? Consumer discretionary versus consumer staples. Your charts are unique and different than what we show. Can you talk through what these represent and what they're telling you?
Sure. Well, since I'm a big fan of the final bar, I do remember that you've been talking a lot about the cyclical versus the defensives. And here I show the equal weight S&P 500 consumer discretionary sector versus the 500 itself. It's simply a 40-week or a 200-day relative strength. So each black dot represents the price change over the last 40 weeks for the consumer discretionary sector divided by the market. And you can see that the green line in the center is 100. Any dot above 100 means it's outperforming the market. Any dot below means that the sector is underperforming the market. 26-week red moving average. And you can clearly see that toward the third quarter of last year, we bottomed out and have started to see an improvement to the point where consumer discretionary is now above the market on a rolling 40-week basis. On the right side, you see, okay, well, where is the strength coming from? Investors are taking their profits in consumer staples. It got more than one standard deviation above the mean. It broke below the moving average. The moving average itself has started to head lower. And on a rolling 40-week basis, because it's below the 100 level, it's now underperforming the market. I like the equal weights because, like small caps, they give you sort of an early warning signal. And if I showed you the technology sector versus utilities, the pattern would be essentially the same.
It's such a great set of charts, and I really appreciate it, Sam, how you threw that together. We only have about 30 seconds left, but I just love to think, given the conditions that certainly seem optimistic, certainly seen the optimism we've seen, but the fact that a lot of risk assets have already had a pretty good run already, where do you look here going forward here in the coming months? Is it in an area like technology, which has been beaten down, relatively speaking, over the last 12 months? Or where should we be looking for leadership going forward?
I think the market's already telling us that. The Stock Traders Almanac with its January Barometer, I have found that if you buy and hold for the coming 12 months, the 3 best performing sectors based on their January performance alone, you outperform the market by a good 250 basis points on average. And the batting average is about 2 out of every 3 years. So consumer discretionary, tech, communication services were the leaders in January and therefore could be the leaders over the coming 12 months.
An encouraging discussion, Sam, and thank you so much. We touched on a lot of different things. Thanks for coming in on a busy day and giving us some very, very much needed perspective. Sam Stovall, it's a pleasure to see you. Be well, all right?
Thanks. You too, Dave.
That's Sam Stovall. Sam's the Chief Investment Strategist at CFRA Research, coming to us from Eastern Pennsylvania. And what a pleasure to be able to talk with someone like Sam on a day like today and try to make sense of things. There's so many different potential and in some ways competing narratives. There's so many different things to follow and things to pay attention to. What I love about the things that Sam said was focusing on price, right? If you're going to pay attention to the signals, look at what price is telling you. the strength that we saw in January, the leadership from some of those FANG sectors like technology and consumer discretionary, all fairly encouraging. And I like that sort of, I love that way of illustrating consumer discretionary versus consumer staples. And a good reminder of thinking about it on an equal weighted basis. That means you're not overweighting things like Amazon and Tesla. It's really looking at the performance of the individual stocks that make that up. And I did not miss Sam Stovall mentioning how much he uses the point and figure chart on StockCharts to get those upside projections. What a great take, as always, from Sam Stovall at CFRA Research. We need to wrap our show, folks, and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1, the dollar moving lower today, along with a number of other things in sort of reaction to the Fed meeting that we've had. That strong dollar through much of 2022 was a big part of the story of, I think, 21 into 22. And you saw how much U.S. stocks outperformed non-U.S. stocks for most of the year. That all changed in a big way going into the fourth quarter when the dollar went from consistently outperforming and strengthening versus other currencies to a period of weakness. Today, you're getting further weakness. And again, that's just the latest data point among many. When I think about the S&P breaking above resistance, flip that over and you see the dollar breaking down through support. A number of trend lines I could draw over the last couple of years, all broken by now, and the momentum characteristics particularly weak. At the bottom, we're looking at U.S. versus everything else, right? Just the U.S. versus all country world ex-U.S. You can see this ratio has been going lower. That is in no small part, if not primarily, because of the weaker dollar. If you think that weaker dollar continues, it tells you non-U.S. stocks certainly could provide an opportunity you're not going to see as much from U.S. stocks. Here's chart number 2. We're looking at E&P, exploration and production within the energy sector. Ticker XOP is the oil and gas exploration and production ETF from S&P. It's the Spider Industry Group ETF. What's interesting about this chart, some of the sectors Sam and I were talking about, things like technology, consumer discretionary, communication services, they do not look like this chart. The energy sector hanging in there okay, but if you look at particularly at the E&P stocks, when I'm scanning for stocks making new swing lows, this is an area where I'm starting to see some weakness relative to other parts of energy and relative to other parts of the market. While the S&P made a higher low in December and now rotating higher, you actually see the XOP potentially making a lower high. So anytime you see the market doing one thing, breaking above resistance, and other things not able to make it to resistance, that tells you there might be something different. I'm question mark in my mind on the leadership from this area of energy, given the fact that the momentum's stalling out, kind of where it tends to do in a bearish phase. Finally, let's recognize strength where it is. Peloton up over 26% today. We've talked about the chart of Peloton at times as sort of a perfect example of long-term trend following weakness, a chart that continued to make lower lows, lower highs, remaining below downward sloping moving averages. In the last couple months, we've now put in a higher low for Peloton, making this sort of inverted head and shoulders bottoming pattern. We've now broken above the neckline. The August peak and the December peak line up pretty well. Today, we gap above there. I still think there's a bit to be proven in terms of follow through. Anytime you have a big day, it's what happens tomorrow that's pretty meaningful. But the strength in a chart like Peloton has to be recognized. So thinking of charts that have been underperforming going to outperforming, you're seeing a lot within technology, and some of these ARC names is what I would call things like Peloton starting to show a little bit of strength as well. Folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close. Special thank you to Sam Stovall of CFRA Research, helping us put this Fed Day into proper context. All of our previous interviews can be found for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.